Today's topic is just going to be about risk management. A lot of people kind of hate on annuities and have problems with it, and just understanding who would get annuity and why, and how all asset classes have some sort of risk, and it's really about managing that risk. I guess anything you want to add on that, Anthony?
No, really everything you do in life has a downside to it. You just got to know, is the risk worth the reward? No matter if it's financial or anything else, you always have to know what's the worst case scenario. So definitely when you're going into investments and putting your money in certain places, you got to know the restrictions, but then also the upside. What's the likelihood that you could come out profitable or earn interest on your investment? But then also, what's the worst that can happen? Can you lose all your money, or can your money be cut in half? And time frame can that be done in? So we can get right into it.
And what people don't realize is when they have stock portfolios that they're investing in, where when it's accumulating, because a lot of times people look at total return and they look at that as like end all be all. But obviously we know things like sequence of return risk can change the outcome for your retirement, which is why people generally say you shouldn't take out more than 4% of your total portfolio if you want it to last a lifetime, right? A good way to think about it is if you could double your withdrawal rate, right? Which essentially means double the amount of income you would get in retirement, or close to double that, right? What would that mean for you in retirement? And that's really the question you have to ask yourself. Is like, what would that mean for you in retirement? And for someone that has, for example, let's use a round number like $1 million, right? If you have $1 million and you have the ability to put into some sort of investment class, you're only taking 4% of that. That's 40,000. That's actually what's going to be helping you for retirement. Versus for some annuity types, based on like interest rates, if you wait a few years, you could get 70,000 year after year. So you're essentially increasing your withdrawal rate by 40%. Right? So it's just a lot more money that you end up getting for the lifetime of the retirement, versus if you just have it all in a stock portfolio and you're trying to manage that risk of the stocks, if that makes sense.
Yeah, especially as you get older to, let's say, your designated retirement age, your main phase of life is going to be the accumulation, meaning work 20, 30, 40 years and are growing your nest egg and saving a bunch of money. No matter where it is, you have to accumulate wealth first. And then the second portion is going to be the distribution phase, or when you actually have to start taking money from your retirement to live off of. And this is where Pascal's actually getting at. Does it really make sense to keep trying to hit home runs with your full jackpot that you've saved over the course of your lifetime? Or when is the correct time to, let's say, just calm the investments down and make sure we're getting a decent return, even if it's not hitting out of the park every time? It's conservative, but then we have mitigated our risk by going into a smaller asset class.
Yeah, there's a certain point where taking more risks almost doesn't make any sense at all, right? And I kind of had this conversation with my brother. He's a business person, so he's always about, let's try to make the highest return possible. But that's the stage in life that he's in, so that's kind of how he thinks about it, right? But as you get older, your goals change and you prioritize changes, right? For people that have accumulated a lot of money, like professional athletes, like I recently talked about like Shaq in terms of how he saved a lot of money in annuities. For someone like him, it really doesn't make any sense for him to take any risk, really, or not, or much risk, really.
Yeah.
If you could make sure that all of your expenses are paid for your entire life, right? And even for him, I'm sure he probably has a more expensive lifestyle than most, but he also has a lot of money.
Exactly.
So by essentially putting a good portion of his money into an account that's going to give him guaranteed income for his entire life, he's making sure that his expenses will be taken care of forever. Because your expenses could be only so high, right, when you have a certain amount of money. Because a lot of times people talk about inflation and how it affects like the price of groceries and stuff like that. But at a certain point, when there's a certain amount of money, there's no amount of like inflation that's going to make food prices go higher for you to the cost of living when you put a certain amount of money away. Like
in Shaq's case, he's diversified into many different industries and businesses, which a business in itself is high reward, high risk. At a certain extent, I would say no matter what business you're in, it's kind of all an equation of how much money does it take to actually get in front of X amount of people that will actually drive cash flow in on the back end. And like I said, he has multiple businesses to where they already know their specific numbers, and he can probably take all of his risk just in his active income. So his passive income or his money that he's just sitting on can go into the asset classes like an annuity or real estates of that sort that has a high margin of growth with little risk to the downside. So yeah,
And I was actually thinking about this. Like, pension income is the only income that's truly passive, in my opinion. Because it's like, think about even real estate.
yeah,
You still have to manage tenants, you still have to do that, deal with properties, whatever it is. So it's less active, but it's not 100% passive.
oh for
And
sure,
if you think about a stock portfolio that goes up and down, right? I get it's passive in the sense of like you're not the one actually working on it, but it still takes headspace. You're thinking about, oh man, the market could crash, whatever it is. It's not like you're completely not thinking about it. But
yeah,
pension income, whether you get a pension from work, and really insurance companies are the companies that offer pensions, right? Or you get an annuity, which is your own self-funded pension, or you get Social Security, which is the government essentially giving you a pension. That's the only true income that's going to keep paying you and you never have to think about it, right?
yep,
So there's a value in the peace of mind just completely having that eliminated where you don't even have to think about like whether a check is coming or not. It just happens, right? And not to say that you have to have 100% of your asset classes like that. I'm not saying that, but there's a certain amount of like comfort that can give you where like there's no asset class that will be able to give you that same comfort and peace of mind when it comes to it, along with obviously increasing the actual amount of money you'll have for retirement, right?
yeah, that's true. Trying to think of another asset class that is going to be, let's say, fully passive, but it's something like a dividend stock. It's passive, but then, like you said, your actual
But
capital
you have
can go
to,
down.
yeah, you still have to worry about like fluctuations and everything. You have
Yeah.
to worry about all the like variables, right? The thing
Yep.
is, there's no variables when it comes to pensions. It's you
Mhm.
get paid this amount of money, and some of them have inflation adjusters, so it just depends. But it's basically, hey, you get paid this.
Yeah. There's that and annuity. Once you start the income rider, are going to be you pretty much know what you're going to get paid out for
Exactly.
the remainder of your life.
And when it comes to the bond market, like people say it has less risk, which it does. The deviation of the bond market moves a lot less than the stock market. But even with that, there is less when it comes to that, but you still have to make sure you're managing your stuff correctly. And they always say, like, as you get older, you want to have a higher proportion of your assets into like a bond portfolio, which I tend to agree with, or you could just use things like insurance contracts, which just essentially give you a guarantee so you don't even have to worry about any sort of fluctuations. So it's just a matter of what you prioritize. And there's been studies that shown that like when you put your money in insurance asset classes, you actually can have more money for the totality of your retirement because of the risk mitigation of it.
Yeah. Not only that, I always think of like when you put your money in insurance, you're able to dim your risk while you're alive, but then you're really buying cash for the future. Like for sure, earmarking money for the future that's going to be paid out to your heirs, whether that be family members, like a religious belief that you want the money to be donated to, or your beneficiary can be anybody. But you're pretty much putting a stake in amount of money that was already predetermined, and all you got to do is hold your end of the bargain, which is to fund your policy thoroughly throughout your life. And it's an asset that you can for sure count on. I like to compare it to real estate because just like you can buy a house that's 100,000, or you can buy a house that's $1 million. Each one of those, you pretty much go into the scenario knowing what the maintenance is going to be. Let's say a mortgage could be $2,000 a month. It could be $7,000 a month. You're going to predetermine that and figure out all the numbers prior to actually purchasing the asset. Same thing with an insurance policy, to where you're going to be able to know the minimum, the maximum of what you could fund the policy with. And you're, like I said, you're earmarking money for the future. It's one of the easiest assets to solidify.
Another way you could kind of so you could make sure your family never messes up the money that you built is you could have the trust. Like you
Yep.
could have a life insurance policy on yourself, and then once you pass away, you could have a trust like allocate some portion to an annuity to make sure that hey, there's going to be some sort of guaranteed element for your retirement, and then you could pay them out some portion of that life insurance afterwards, just to make sure that your family never really ever runs out of money. I'm sure that like If you have that trust structure, you'll be able to continue to build wealth in perpetuity by doing that, because you're just essentially making sure no one can make any mistakes. It's like it's a guaranteed contract. So
Exactly. The best thing about the trust is that you could be specific on how much money you want to be paid out to your beneficiaries, let's say upfront, or they have to hit some type of certain qualification or age to be able to have access to an amount of capital. And then, like you were saying, put money straight from when you pass into an annuity that pays out annually or monthly to all your beneficiaries. That is an automatic, pretty much sprinkler of money that is going to be propelled out to beneficiaries for life.
we are really just about making sure you're managing risk and being aware, because obviously whatever asset class you save in or invest into, there's going to be some sort of risk. Even for fixed asset classes, it can be affected a little bit more by inflation versus something that is linked to the stock market or linked to the real estate market, where inflation a lot of times helps those asset classes. But there's a balance to both, and you're just figuring out which one makes the most sense for you in order to get the outcome you want for retirement. Because if, for example, for you, hey, I need 80,000 every single year to make sure everything is set for me for retirement. There's a certain point where taking more risk to make more money might not make sense. So you might want to lock in some of that to get to that point where you could almost guarantee to have your baseline for retirement.
Exactly.
And then
that's
there will be some upside if you have market assets.
Yep. And that's really the main focus of today's call, is just to be aware of, let's say, the risk that does come with any investment. Know the worst side of things as well as the best side of things, and know that, or actually ask what the likelihood of like an average return, because most of the time the stock market is just on average right around 7%, but people like to promote that it's going to make 12, 15, 20%, and that's not very likely to happen every year. It may happen one out of a few years, but what's the average amount of returns you're going to receive in any asset? That should be the main focus, and prepare yourself for the storm, if there is any.
You have to prepare yourself for the variables when it comes to retirement. But yeah, we just really wanted to top on live for a little bit and just kind of talk about a little bit of financial concepts. We're going to be doing this more live on TikTok too as well, where we kind of go over these different things. So I guess, Anthony, where's the best place for people to find you? If you have questions on just retirement planning in general and all that stuff.
Yeah, if you got any questions related to finances at all, you can reach me at Anthony Enriquez at any of the major platforms. That's YouTube, TikTok, Instagram, Facebook, and we'll be happy to answer any questions. Or even if you go through our past catalog of posts and stuff like that, if you have any questions, feel free to leave a comment and we'll get back to you.
You guys can find me at financial_ownership on TikTok. Also financial_ownership on Instagram. I'm also on YouTube and Facebook, but that would just be no underscore, just financial ownership. So if you want to tune into my content, feel free to subscribe. My YouTube channel has more in-depth content where I talk longer form content, 15, 20 minutes. So if you're interested in just financial concepts in general that are going to help improve your situation, just make sure you follow those pages.
Yep. And I seen that your comment was wish you could have logged in sooner. We'll be back next week, Wednesdays, when we typically go live right around 7 p.m. Central Time. So I'm not sure if that time works out for you, but Monday and Wednesday is typically when we're going to be live, me and Pascal, either on Instagram or on TikTok. So appreciate you guys coming today.
Have a good one, guys.